We've been here before, in a way, with President Trump. We've seen his tax playbook before, but there are new wrinkles in it. Tell us what we should expect. He's certainly going to concentrate, it would seem to me, on re-upping a lot of those 2017 tax cuts and maybe deepening them.
Yeah, so what's interesting in this campaign is somebody called it the Oprah campaign, where it was, you get a tax cut and you get a tax cut. So it was overtime pay, you get a tax cut. If you make your income from tips, if you're a server, you get a tax cut. Social Security, older voters, you get a tax cut. So we have a chart where we added all these up together. And if you just extend the 2017 tax cuts, that's about a $4 trillion addition to the deficit. Right?
Over how long?
Over 10 years? A 10-year period.
Over a 10-year
right?
period.
So if you add in the extra campaign goodies, so if you extend that $4 trillion, overtime pay, how much could that? Well, that's actually $1.8 trillion that costs over 10 years just for overtime pay. Tax on Social Security, that's a big one, $1.6 trillion. Salt reversal, we're going to talk about salt in a minute. How many of you are affected by salt and the salt cap?
The state and local tax.
All right, yeah, a lot of hands here. So that's going to be a big one. And then talking about the lower corporate tax rate for domestic manufacturers down to 15%, that would add $700 billion. So all that together, about $6 trillion plus the $4 trillion, $10 trillion added to the deficit if he does everything, offset with about estimated, at best case, $3 trillion from the tariffs. So best case scenario, if you add everything in, it's about a $7 trillion addition
So
to the
is
deficit.
the idea then, the overarching idea, to replace taxes on income with taxes on things, namely tariffs?
Well, there are some who say that's the sort of secret plan here. There have been many people who said, let's try a flat tax.
I mean, we didn't have an income tax until, what, 2015? 1915?
Yeah,
like that?
and it's
2015, I'd be a lot richer.
If only.
I'd be so
if only.
damn rich.
And at that point, it was essentially the Rockefeller tax, right? I mean,
Yeah.
It was a 90% tax on the top. So what's different this time, and Tyler, you mentioned the term tax cuts. I want to correct everybody, including everyone on our air, including me, that says tax cuts. These are extensions. These are what I call tax keeps. So, because it's very unlikely that we can afford, remember when these passed in 2017, we had a budget deficit of about $500 billion. Now it's $1.8 trillion. Very different scenario. A lot of deficit hawks in the House are not willing to add $4 trillion to the deficit right now. So, you might be able to extend these now that it's been a red sweep, and if they get control of the House. What is going to be tough is these additional things. Let me talk about salt for 1 minute.
Sure.
What is likely to happen, I think, with salt is there will be people from blue states, Republicans in blue states, and as well as Democrats who want it repealed. That's not going to happen. It's way too expensive. What is likely to happen is maybe it gets raised from 10,000 to 20,000. More likely it gets indexed for inflation. Because remember, when they passed this in 2017, real estate property taxes were much lower because of housing values than they are today.
The receipts that derive from that.
That's right. So the number of people that are caught by that cap is much larger today because of inflation. So there are people saying, double it to 20, index it for inflation, and get rid of what's known as the marriage penalty because it's only $10,000 per household, whether you're a single taxpayer or a double taxpayer. So there's no way they're going to repeal SALT because it is too important as an offset for all these other revenue raises.
Including a desire, as I understand it, to reduce even further the corporate tax rate from 21
to 15.
To 15.
That's
Let's
right.
talk about something that comes up every so often, and that is the idea of wealthy Americans who are interested in leaving the country and repatriating somewhere else because the tax regime there is better, or for other reasons.
If you're a global investor, this is a very important trend. It started during COVID, and it was part of what was called passport portfolios, where the wealthy who are the most mobile, the most global, were not just hedging their financial risk, they were hedging their personal country risk by developing a second, third citizenship in another country. It makes sense. That started in COVID. What has happened more recently, and I wrote an article about 3 weeks before the election saying I talked to attorneys who specialize in investment visas. They said their business had more than tripled over last year. That article got over 500,000 views on the internet. And today, those attorneys are telling me they're getting overwhelmed with business. And what it is people saying, it's not so much if so-and-so is elected, I'm going to leave, although there are those people. It's more a dissatisfaction with, could be anti-Semitism, could be Islamophobia, could be just gun violence, could be just the broad partisan nature of this country. But money is on the move like never before in the world. And so, so the question is, where are they going? Where are the wealthy going? Well, Malta is the new hot spot because you get a passport there. It's about $600,000, $700,000 for a passport that gives you access to all of Europe.
And you don't have to have any relatives in Malta.
You don't have to have it. Now, you mentioned you had an Irish citizenship.
I got an Irish passport because my grandmother was born
through
in Ireland.
ancestry. Those are popular in Italy, Ireland. So these are passports, and they're generally more expensive. St. Lucia, you buy a $300,000 beach house in St. Lucia, you get a passport for free. That's the ultimate BOGO, right? You get a passport and a beach house. The other thing that's happening are what's called permanent residencies. So these are big in Europe. Americans are really going to Europe. So Greece, Portugal, Italy, Spain, between 250,000 and 500,000 euros, you get residency in these countries and you can travel throughout Europe. Although the downside versus a passport is that you have to renew it every 5 years.
This is a visa situation as opposed to a passport
It's a visa.
situation.
It's a residency, yeah. And one last caution, because so many Americans are taking advantage of these programs, these countries are doubling the price. It's also driving up real estate values so much that the locals there's a backlash. So act now because these prices are just going up because so many Americans are taking advantage.